Well, hey, it's good to see you guys again. Up for the first quarter of 2024 update ending here recently at the end of March. We've got Casey with us again. Casey, how have you been? How's the first quarter of the year
I've
been
been
for you
great. It's
guys?
been busy, but overall, it's been a really good start to the year. And I think we'll have a couple of good talking points to explain exactly why it's been so good.
Yeah, yeah, man. I appreciate that. I'm excited to see. We actually have some slides here today, and so what I'm going to do is tee that up for us. And there's a few specific things that we want to cover. So let's get into that.
Absolutely. This quarter, I think one thing that we've really been focusing on here at Horizon is comparing today's current market and economic environment to the 1990s. And again, if you look at the 1990s or what reminds us of the 1990s, I think the first thing that comes to mind is, the big productivity increase that we had because of the internet and, personal computers. Obviously, that was a brand new technology, and it took a couple of years for it to catch on across all industries. But as we all know, it was a huge driver of economic growth during that period. Today, we've all been inundated with hearing about AI, and we really think that AI is kind of in a similar vein to the productivity gains that we could experience, similar to what we had back in the 1990s with the internet. Looking at some of these charts, from a popularity standpoint, is it easy to use within businesses? It looks very, very similar to the internet back in the mid 1990s. One thing that I really do want to point out that I think is important is this point here. Is it impactful across different industries? And I think that this is an unappreciated point with AI right now. I think a lot of people think AI is just, going to be useful within the tech sector or communication services or something along those lines. But we're seeing really broad adoption across all different industries, across all different sectors, within financial services, within healthcare, even within utilities. We're starting to see these companies start to adopt AI. And we do think that, again, this is going to be a big productivity boost, similar to what we saw back in the 1990s. So, I think that AI is definitely here to stay. We're in the early innings, but we do think that it's definitely material going forward.
I appreciate that. I was just watching a documentary recently on how quickly the technology is advancing. And so, how quickly we went from document generation to photo generation, and within much quicker than was anticipated, within I think it was about 10 months, they're actually now able to make movies all with
Yep.
AI. So, I know there's challenges with Hollywood and the unions and things like that, but it is moving faster than we realized. And I think the adoption rates are going to be stronger than anticipated
Yeah.
as well. Would you be willing to go on to the
Yeah,
next slide?
absolutely. So again, comparing today's environment to the 1990s, we talked about the similarities from, a broad theme in being AI. But if you look at some of these key economic growth metrics, they look substantially similar. So the black lines here are all going to be the averages of the 1990s, that entire decade. And then today is going to be the averages from 2020 until the end of last month. And again, remarkable similarities, whether it's inflation, the CPI year over year change. You can see throughout the 1990s, it was right around 3%. Today, we're sitting maybe a little bit higher than that, but not too far off. 2 year treasuries, so again, interest rates are actually a little bit lower today than they were back throughout the decade of the 90s. And I think that's something that we hear a lot is, and maybe it's a big concern that a lot of investors have is, this current interest rate environment, it's too high to sustain, positive economic growth. Look back over the past couple of decades, we haven't seen these types of interest rates, so inherently it's going to cut into consumer demand. But again, go back just 3 decades into the 90s, and we actually were able to sustain really positive GDP growth, as well as really positive price appreciation from equities and fixed income during that time period. So it's not too far fetched that we are able to sustain positive strong growth, even with somewhat elevated interest rates right now.
Yeah, I think I've definitely heard the conversation around bubbles and asset bubble and tech bubble. I think one of the things you and I were discussing before we got on the call was the significance of how this time around the earnings are actually there. So, would you be willing to pop over to that component to where we can look through
Yes,
that real quick?
we do hear from a lot of clients that there are concerns that we are in some sort of AI or technology bubble. Again, we've all heard the stories of companies like Nvidia that are up, multiples of where they were, even 12 months ago. But going back over the past 3 years, Nvidia is up almost 10 times in that short time period. So that feels like a little bit of a bubble. And again, looking back in the 1990s, we all know how that decade ended with the dot-com bubble. But to Chris's point, you look at the profitability of, those mega cap companies back in the late 2000s or the late 1990s, early 2000s versus today. Companies today are substantially more profitable. I mentioned NVIDIA. NVIDIA has a net profit margin right now that's north of 50%. So really making money hand over fist. These companies are not in financial distress, have very little debt on the balance sheet, and again are growing at just very strong and healthy rates right now.
Yeah, I think when I've seen some of the earnings numbers come out, it became a little bit more compelling. I agree, valuations or excuse me, like stock market valuations have been a concern. It just seems like things have rocketed higher, but the things that are winning are, definitely rising the tide, bringing up the other boats as well
Mhm.
in this season. So the next piece that we had set up was discussions around debt, and clients had concerns about that. Would you pop over to that slide?
Yeah, absolutely. Um, so again, we are in a much higher interest rate environment, and as I mentioned a little bit earlier, a major concern is that these higher interest rates are going to put a lot of pressure on the consumer and really affect their spending, and maybe more specifically, their discretionary spending. One thing that we took a look at was just what's the makeup of consumer debt right now? What percentage of that is fixed versus what percent is going to be variable? And again, looking back over last year, about 90% of consumer debt right now is fixed. So essentially, what that means is that even though we are in a higher interest rate environment, the majority of your debt payments are not going to be affected by these higher interest rates. It's really a small portion of your overall outstanding debt that is going to be impacted by these higher rates. And that's really, I think, a big reason why we've seen consumer spending continue to chug along. Again, even though the outlook for interest rates continues to be a little bit higher for longer.
Mhm. Yeah, the reason I was bringing this up is because I think it was in recent years you've hit student loan debt, heard student loan debt hit all-time highs, or auto loan debt hit all-time highs. But when you look at the entirety of debt and how it's slated, there could be higher indebtedness. But it's so many times when you and I have these discussions, Casey, there's things below the surface. If you get the rest of the detail, if you get the rest of the context, it tends to remove the clickbait of the banner and the headline and the newsworthiness that attracts so much attention. And then all of a sudden it's like, well, yeah, it is higher, but now you understand the rest of the picture. So I wanted to just jump into that. And I think when people looked at the higher interest rates, I think that there can be impact to it. But the truth is, you can see that so much of that is already locked up in fixed rate assets or fixed rate debt. So the impact could be there, but and it obviously is affecting certain segments with commercial real estate and things like that, I'm sure.
Right.
But to the typical consumer for your portfolio, it may not be as immediately as impactful. Okay, I think we had just a couple more here. The next one, I believe, is on inflation.
Yes. So I guess transitioning over to, with the backdrop that the consumer is still in a pretty healthy place, you look at maybe total liabilities relative to total assets or total income, still very, very strong. We know that a lot of consumer debt is maybe longer term fixed. People were able to refinance their mortgages at very low rates. So from a balance sheet perspective, consumers to be actually healthier than they have been in a very long time. But we hear from people all the time how frustrated they are with the economy. And I think a large portion of that has to do with inflation. And I think one maybe more frustrating conversation that happens is that we've heard that inflation is coming down and it's normalizing, but we all go to the grocery store and we still see very, very high prices. And that's exactly what this chart here is showing. So going back to before COVID, looking at basket of grocery items that we're going to buy on a weekly basis increased substantially in the early years after 2020. And so what this really shows is that a basket of goods that maybe cost $100 back in early 2020, late 2019, fast forward 24 months, all of a sudden that's costing you $135, $140. That's very, very alarming. And again, over the past year, inflation has come down, but you can see that the prices haven't come down, right? And again, that's the confusion around inflation. Inflation coming down doesn't mean that prices are going to come down. It just means that the rate of change isn't necessarily going to be as high as it was before. And so again, we're not going to move back down to this same basket of goods costing $100. It is going to be higher. It's going to be at this $140. Going forward, maybe a little bit higher year over year. But one thing that we have seen is that wages have also increased. They've actually outpaced inflation over the past couple of years. So that is one positive thing that we are seeing out of this. But we are right there with everybody that some of these higher prices that we're seeing at the grocery store or at the pump are very, very frustrating.
Mm. Yeah, no, I know. You hear people complain about it, and I know that inflation has persisted. But I appreciate the clarification that the values, the pricing, the expenses may stay where they are, but the rate of increase is definitely starting to be impacted. All right, so I just showed a couple more here. One, clients had come back and forth over the last couple of quarters around concepts involving interest rates and its impact. And as interest rates push higher, how does that affect all of us? And so if we can kind of just step into that a little bit, I think this next slide brings some clarity to any potential dangers with that rising interest rate environment.
Yes. So this chart here is addressing the question, how high is too high for interest rates? How low maybe is too low? And you can see over the past couple of months, we've been in this range of 4 to 4.5% interest rates. Over the last maybe couple of weeks with some somewhat hot CPI inflation prints that's gone up a little bit. But essentially, looking out over the next 12, 18 months, we really expect interest rates to stay somewhere between, this 4.5, potentially start to move down into the 4 to 3.5%. And all of that range right there for interest rates is going to be very healthy for not only the economy, but also for broad investments. So if you think about equities, generally equities are going to be valued based on the prevailing interest rate. So higher interest rates tend to be negative for the valuation or the multiple that you can assign to these equities. Lower interest rates tend to be more positive for market multiples. So even if we stay in this current band right now of 4 to 4.5%, which is absolutely higher than it has been over a longer period of time, we have started to see equities or S&P 500 companies more specifically start to have really strong earnings, which is going to be supportive of future price appreciation for equities. If we get some sort of moderate decline once the Fed does start cutting interest rates, again, that is likely to be very broadly welcomed, not only by equities, but also by fixed income, because we will start to see some price appreciation finally within the fixed income space. Our concern really has to do with yields rising beyond 5%. On the 10-year treasury. We're a little ways away from that, but essentially we don't expect to get that type of scenario unless we get some sort of massive inflationary rebound. Right now, that doesn't look overly likely. And then again, too low would be something below 3%, because really we don't expect to get down into that area unless there is some sort of massive economic shock that puts a lot of downward pressure on economic growth. And the Fed is then forced to step in and cut interest rates pretty significantly in order to address that weakness.
Yeah, I speaking of the Fed and rising interest rates, I think that there's been discussion around that they're going to have a few token interest rate hikes. They'll be mostly sentimental in nature, but the truth is, I think that most will agree that they need more ammunition, right? They need more to be able to deploy. And so historically, we've been so close to zero, right? Between 0 and 25 basis points that there's not much they can do except for popping into a negative interest rate environment. But we definitely don't want to do what Europe did. So, all right, well, Casey, what else do we need to be touching base about here during this update?
I think we touched on a lot of really important, aspects. Again, it has been a really strong start to the year. In the first quarter alone, U.S. equities, looking at the S&P 500, are up north of 10.5%. We do think that there is potential for the market to continue to rally from here. Again, based on a lot of the things that we just talked about, but we do maybe want to level set expectations, and we don't expect the market to continue to increase at a 10.5% rate quarter after quarter. So maybe some modest price appreciation from stocks to finish out the year. Maybe another 5 to 10%. I could definitely see that being a possibility. But again, we've had a really strong past 6 months for equities. It's been really great to see on statements. But let's maybe weigh in some of our expectations there.